In the prequel video, I had analyzed the 4 economic reforms that I acknowledge under Modi 1.0, and these are Ujjwala, Insolvency and Bankruptcy Code IBC, Direct Benefit Transfer DBT, and the Goods and Services Tax in that order. And now is the turn to look at the failures. Since Modi ji loves to bandy stats, I too shall rattle off a barrage of data points, real data points, rat-a-tat-tat. So here goes. First, we'll look at real interest rates. Now, this is the difference between the base interest rate in the economy, which could be the 10-year Treasury or the State Bank of India prime lending rate, minus the rate of inflation. That's a real interest rate. Contrasted against the healthy sub 5% mark during almost the entire UPA decade, real interest rates have actually flashed a bloody red. They've soared above 9 to 11% under Prime Minister Modi. This has happened despite a benign inflation situation, which simply proves how this government has chomped at the nation's dwindling savings, keeping real interest rates high and crowding out private investment. Now, the second impact is in weak consumer demand. It's no surprise that high interest rates have actually virtually killed consumer demand. Retail auto sales declined by 8% in February over last year. Maruti, the overwhelming market leader, cut production by 27% in March. Even two-wheeler manufacturers have scaled back by 15% year on year. Tractor and truck sales have plummeted, the latter by over 20%. Domestic air passengers have shrunk by double digits in this quarter. Exports have struggled since 2014. You'd be surprised to know that only in the fifth last year of the Modi regime, they are on track to post about 330 billion, and that's just marginally ahead of the $313 billion record set by the UPA in financial year 2014. What we're also seeing is very weak core sectors growth. 8 industries: electricity, steel, refinery products, crude oil, coal, cement, natural gas, fertilizers, all of them have hit an 18-month low. We're also seeing the slowest profit growth for corporates in 5 quarters. Analysts have cut their earnings per share or EPS forecast for 151 out of 253 listed companies after the December quarter results came out. Under the UPA, EPS growth got a negative shock in the post-Lehman crisis year of 2008 and 9. But otherwise, growth was robust, hitting above the 20% mark in several years. Under Prime Minister Modi, however, EPS growth was negative over 2 consecutive years and has only marginally been in double digits in other years. We're also seeing banks whose balance sheets are quite ravaged. To its credit, the Modi regime allowed RBI to undertake a transparent asset quality review in 2015, and that unearthed a shocking mess of bad loans. These quadrupled under Prime Minister Modi's watch to over 10.6 lakh crore, that's 11.6% of aggregate bank assets. Even after 3.4 lakh crore have been written off, the gross NPAs will hit 10.3% this month. Non-food credit is lower than what it was in 2015. We are also seeing that the balance sheets of central public sector companies, CPSEs, have been denuded under the Modi regime. It literally forced CPSEs to aggressively buy back their shares so that the cash on their balance sheets could be transferred to the government. Unfortunately, this has resulted in a massive erosion of wealth, with all such shares quoting well below their buyback price. And you note this, they're quoting below by an eye-watering 17 to 54%. Ordinarily, when companies buy back their shares, the prices should go up, but they are down by 17 to 54%. Over the last 2 years, the Bombay Stock Exchange PSU index has lost 13%, while the BSE Sensex has gained well over 21%. Worse, the government has raided their cash surpluses, which are down almost 40%. That's by over 1 lakh crore since the Modi government took power. Now imagine a Navratna, that's supposed to be an immensely valuable company like BSNL, delayed salaries this year. That's shocking. We are also seeing fairly anemic stock markets. I mean, I know we are currently in the middle of a very, very strong burst, but before this current short burst, India's stock markets were in the doldrums. Two-thirds of the 364 equity mutual fund schemes were in the red. 78 schemes had mauled their investors by over 10% in 1 year. Inflows into pure equity schemes had dropped to their lowest levels in 25 months. And in a real blow to the Modi narrative, the Nifty grew by nearly 29.6% per annum in UPA 1 and 20.7% per annum in UPA 2. But compare this one, an anemic 11.6% every year from 2014 to 2018. That's ouch for the Modi government. Now let's look at lagging foreign direct investment, FDI. This one will hurt as well. While the Modi regime always goes ballistic on its pro-FDI policies, the UPA scored a 10.7% annual growth over its decade. That's a good 2 percentage points higher than the 8.7% annual growth logged by Prime Minister Modi. FDI as a share of GDP has plummeted from a high of 3.4% in financial year 09 to 2.3% in financial year 19. In fact, for all the fancy talk, FDI has contracted by 7% in the current financial year. Now let's look at agriculture distress. You know, this phrase has become a painful cliche under Prime Minister Modi. Growth hit 2.7%. That's the lowest in 11 quarters. Worse, since food prices are in deflation, the actual income earned by farmers, and that's actual income in rupees and paisa, grew only at 2.04%. Now hold your breath here. That's the worst in 14 years. Compared to the UPA 2's annual average growth of 4.3%, Modi has notched a very meager 2.9%. Finally, jobs. Now this has been hotly contested by Prime Minister Modi, but the numbers are scary even if they are massaged down in what we can call an honest review. Nearly 2 crore male workers have gotten so disheartened that they've just simply dropped out of the workforce. And the unemployment rate has gone up to 6.1%, and you've got to hold your breath here. It's the highest in 45 years. What can I say? Ouch. Again. Okay, so I'm now going to stop twisting the knife any further. I've really rattled off a barrage of real data points which are not flattering at all. I will of course not mention that GDP growth has slipped to a 6-quarter low, that we are less healthy than Nepal, Sri Lanka and Bangladesh. I will stop very soon that we have fallen on the happiness index. I must stop.